promise to cooperate with the regulators as they do.
Are you planning to return a single nickel to what you cost the fund?
Senator, I know there's going to be a process review of compensation.
I'll take that as a no. So you're planning to return how much?
The answer is
none. That's it?
I'm not planning to do so, no.
Okay, so here's the thing. Right now, the law says that people like Mr. Becker and Mr. Shea can come to Washington, they can lobby for weaker bank regulations, they can load up their banks with risk, they can pay themselves tens of millions of dollars in bonuses and stock options, and when the banks blow up, Mr. Becker and Mr. Shea get to keep all the money. And that is just plain wrong.
Morning, Melinda. Did you trade US yesterday? Okay, yeah, it was quite a nice day, and as well, I trade the open of the session, take few trades, and before the move happen, I close everything. So missed the nice move up, but definitely it was quite a nice day. So now we'll be waiting for the bit of the retracement, as everything showing us that we are in a bit of the sell. We're failing to go and test the heights, so I need to go grab some money below. Okay, Frankfurt in 2 minutes. 15 is far away. And I noticed that, yeah, on a 5 minute we got the wedge. Okay, we got new 4 hour candle. The value area move a little bit higher.
Good morning. Welcome to Bloomberg Markets Europe. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins us from Singapore to take us through the market action this hour. The cash trade is an hour away. Here are your top headlines. Deal in sight. President Biden expresses confidence that debt agreement will be reached. House Speaker Kevin McCarthy says it's doable by this week. Buoyant sentiments. Asia stocks extend yesterday's rally on Wall Street as conviction builds the US default could be averted. Travel in focus. We will speak to the CEO of the airline EasyJet as it reports first half earnings this morning. We'll ask about summer demand, inflationary pressures, and the guidance. So welcome to the program, everybody. Mark joins us, as I said, from Singapore. Mark, good morning. What are the markets saying to you?
Good morning, Anna. Well, as you mentioned, it is a positive session for stocks at the moment. We're generally seeing higher yields as well. We're seeing a stronger dollar generally. We're seeing higher commodities. It's really a risk-on read out there. And for once, I'm not being difficult. I'm not fighting it. I think it all makes sense.
It all makes sense. Okay, let's have a look quickly at the futures picture for European equity markets and the US. The futures picture in Europe looks pretty positive this morning, up around 0.5% on some of these markets. Yesterday we were mixed in Europe. US stocks, though, went higher, closing near their session highs. Some of those markets up by 1%. Confidence being expressed by President Biden and also by some Republicans about no US default. Those were the sentiments expressed by President Biden. So that's where the market's sentiment is on that one. Let's have a quick look at US futures, and they don't paint such a positive picture, but as I say, they rallied on that idea yesterday. Mark, what do you see on the GMM?
Well, first of all, it's mainly stocks positive. There is an exception. China stocks continue to underperform, continue to disappoint people, and I think that's going to be a theme in the next week or two after the very disappointing data earlier on this week. Japan, look at that bright box at the top. This has been a macro theme which the community has got overall, so people are very excited, really loving this trade. It's been a real outperformer in the first part of this year. But the other big stock markets apart from China are doing well. South Korea, Australia, India. Dollar is stronger. Generally, EM currencies are weaker because not just because dollar strength, because the yuan is weakening. Again, it goes back to that China disappointment, which plays into the EM story. It also plays slightly into the commodity story, which are a bit more mixed there, I will admit. But the other part of this is US yields went higher yesterday. That is fed through to the Asia session again.
Okay, that's the markets, that's the overall markets. Let's get to some breaking news then coming through this morning here in London. Numbers through from EasyJet. Headline pre-tax loss of £411 million. The estimated loss was a slightly bigger number, 418 or so million. The revenue number has come in pretty much bang in line with estimates. Let us get to a conversation about what the future holds then with the EasyJet EasyJet CEO Johan Lundgren. Johan, a very good morning to you. Welcome to Bloomberg Television. Thanks for talking to us. So the numbers seem to be in line with estimates, which leads me to ask where you think things go from here. What can you tell us about how things look for the crucial summer period at EasyJet?
Well, as you said, it is a strong demand environment as well. And just over the winter, we had 41 more customers traveling with us than last winter as well. And this is something that is come from two things, really. One is that people have really looked upon travel now, very differently than they did prior to the pandemic. This is now firmly at the top priority when people choose on how they're going to, allocate their discretionary spending. And that is something that is coming through in the numbers as well. So we are ahead of last year now in terms of the booking from a load factor point of view, both in Q3 and Q4. I mean, looking forward to that to continue.
Okay, so despite the loss, you're presenting a very positive picture about the spending on travel. The outlook's looking positive.
You are
Percentage growth
green.
for later this year. Will you be placing a large order for a new aircraft, like some of your rivals have done, like Ryanair and Wizz Air?
Let's see if one minute will hold. I took the TP1.
That we already have an aircraft order of 163 aircraft. So that's the current order that we have that we will exercise, and that will take us out to 2028. And that is a combination of both replacement of the existing fleet that we have, but also then growth as well. But already, if you're looking at the growth numbers, we are growing our network, and excluding some of the changes we've done to some of the underperforming bases we have. In the UK, as an example, we have 1 more million seats this summer than we had last summer, as an example as well. So, we will continue to grow, and already for next year, we're looking at 10% growth, and we have the fleet in order to support that.
If I ask you about expansion in the UK, Johan, I think you're committing further to Birmingham today as a base. I think you already fly there, from there to around 10 different places. So I wonder what this really does signal about confidence in the UK story. What can you tell us about that?
Yes, you're absolutely right. I mean, it is a sign of confidence for us in the UK. And as you point out, we have been flying to and from the Birmingham airport here since 2007. So we've seen that has, grown in terms of the performance in there. It is the second largest city in the UK as well. And with the 3 extra aircraft we're putting in there at the base, that will support hundreds of jobs and indirectly about 1,200 jobs as well. We're going to have about 16-17% of the market share for the next summer. So we're very, very excited about this. And it's the first, as you say, it's the first base we're opening and launching in the UK since over a decade. So we're really excited about this.
So, yeah, you say you're increasing capacity. You have more aircraft coming in. We've discussed what actually your major rivals do as well. You believe the UK, you've got an extra million seats flying to the UK. There's somebody you mentioned. Are you having excess capacity coming into the system? And what's that going to do for yields?
Well, it's an interesting question. I think because of the OEMs or both Airbus and Boeing have, documented, challenges in terms of delivering on their orders, we think we're in a good position on that. We're one of the largest customers of the Airbus A320 family, as an example. So we believe that, we're going to be able to mitigate any
Bounce
challenges
back from the
that
POC.
might be
It's
coming.
nice.
But I think in general, you're going to see that the supply from a manufacturer's point of view will be relatively tight here from the next 3-4 years. So of course, that would have a positive impact on the yield environment. As long as
Yeah, it was
the
quite strong area. There was a
demand
POC
that has
view up
continues to be strong.
in the
And
middle
just
of
for
the
that
structure
very reason
channel.
that I said earlier, I don't think that this is so much now, a pent-up demand we're seeing following the pandemic and the travel restrictions being around. I think that actually people's views on travel have changed. This is now more a priority versus house renovations or going out for dinners or doing other things with the discretionary spend that we have. And I think that now 45% of
Very small
UK consumers
ATR.
say that we're more likely to book with a low-cost airline. That means that people gravitate towards value, which is exactly what you've seen in other times when there have been, challenges on households. So we believe that this environment here on the demand side is here to stay.
Yes, maybe an EasyJet flight ticket easier to find than a builder, Johan. Let me ask you about what people are spending their money on. We've got, you're talking quite a bullish picture there about the growth prospects at EasyJet, but are consumers spending as much when they're on the aircraft? So
the ancillary revenue is coming in very strong, but that's more down to the fact that we have made a step change in our offering. So we see now that more people are buying the ancillaries. We see that we have higher spend on ancillaries as well, and because of the model that we have done in
So far, it
terms of
looks
now
like the
making
bottom of
contracts
the
directly with suppliers,
Frankfurt
we see that
opening
we have a
range is
higher
holding the
profit
price.
at the same time as well. So this is really coming through all at the same time as well. And the great things about the ancillaries is, of course, that it gives people a
And
choice.
break
Not
even
everybody
after
wants
the
to check in
first
a
TP.
bag, as an
So
example, and therefore not everybody should pay the cost of the
the
150
worst case
euros, as an
scenario,
example. So we're really
I won't be
defining
able
how
to
we're
join
going
the
to offer the
long,
customer ancillaries,
but
and also the way
still,
we merchandise
I
that
wanna see
by
retracement
introducing
after
more
yesterday
bundles, by
run.
making it available
This
both
is
on
why
the
I'm
web
not
and on the
interested in
app,
it
by
yet.
improving reminders to people when and how to buy this as well. It makes a big difference for us because it's essentially revenue that's coming in where there's no cost really attached to that as well. So that is an important part
Okay,
for us in order that we can keep the base fare at a low price. And I give you an example on this. Just
why
because
am on
everything that you pay now with
RTY? It's
EasyJet now
already
within the
on the
system, from
bottom
now
of
up
the
until
Sydney
the winter,
Tokyo.
50% of that would be under £50. It represents extraordinary value to compare that to many other things. You can even fill up your car for that, and with that you can fly basically anywhere in Europe. So I think that we are in a very very good position. We know people gravitate towards that when times are challenging on the economical side and the household.
And we're printing
Can I just ask briefly about staffing
bullish
costs? Clearly, that's
reversal
been an area
lines.
where a lot of businesses have been facing a lot of pressure recently. I just saw that Singapore Airlines has decided to
But
pay
the
an 8-month
bearish
bonus, the
volume is
equivalent of
really
8 months'
tight.
pay to many of its staff. What pressure are you feeling on that front?
Yes, we have concluded the majority of the deals that we have with our union representatives as well, and we come in, below the inflationary cost in there. But it's true that we've also done one-off events like we did last year, as an example. We're also giving our people and our crew third-party discounts on products and services they can use as well. So I think you have to look at the overall mix on how you reward and how you also engage with your community. And of course, you need to pay competitively, but that's what we've been doing. But I can, we announced this morning as well that our cost per seat, the headline cost per seat that we have ex-fuel this summer, we expect to be flat. That tells you also some of the things we're doing to mitigate some of these cost inflationary pressures. But of course, it's very important that you have competitive terms for your crew.
Okay, thanks very much, Johan. Really good to speak to you. EasyJet CEO Johan Lundgren, thank you so much for joining us this morning. And let me get some other breaking news we've had out this morning whilst we've been having that really interesting conversation about the aviation sector. Burberry in the luxury space giving us their numbers. Full year retail comparable sales up by 7%. They are maintaining their full year 24 and their medium-term targets, so no change in terms of those overall targets. They also say that revenue was accelerating in the fourth quarter as growth rebounded in China, certainly a theme we picked up on with many other luxury businesses. Let me also get to some breaking news out of BT, the telecommunications business in the UK. BT to cut a total number of staff, its total number of staff, from 130,000 to a range of 75 to 90,000. This is by 2028, 2030, so there's quite a lead time on this. And looking out the next 5-7 years, they're going to be taking quite drastic action in terms of the headcount. We will look for details as to how much of that can be done with attrition and how much of that is redundancy. So BT announcing plans to cut up to 42% of its workforce by 2030. Coming up on the programme, we'll stick with earnings stories. We'll talk to the CEO with the media company Future, which owns brands such as Marie Claire and Tech Radar, as it reports first half results. We will discuss the challenges facing digital media companies in an uncertain economic environment. Plus, could a debt deal be in sight? President Biden expresses confidence on reaching an agreement. More later this hour. This is Big Bang. Welcome back to Bloomberg Markets Europe. 45 minutes until the start of cash equities trading. The futures picture for Europe looks positive, looking to catch up with sentiment stateside. Mark, let's talk about the market in 3 minutes. And let's start with your thoughts on Wall Street yesterday, how that's been feeding through into Asia and looks set to feed through into Europe. Quite a lot of optimism and quite a lot of politicians suggesting that it is possible to avoid a default or a deal is moving through this week. We hear from the Republicans. From our experience, though, of previous debt conversations, I mean, often we have to go to the edge, look over the edge, witness what happens to risk assets as we peer over the edge, and that seems to focus minds, and that's when we get a deal. So what expectations do you have?
I think that has been the precedent. However, it's been interesting that almost every senior politician is saying, look, we're not going to default. They're just like making it clear. And I think
PLC really holding the price
they're
on the
much
queue.
less fractious than I think many of us feared, including myself a couple of months ago. So, I said this last week, I'm quite optimistic. I remain quite optimistic. I actually think the deal
Starting bullish reversal line on the short should continue.
I think we do go beyond Johnny Yellen's chosen exit at the start of June. I think that will cause a problem. But ultimately, that is a slightly arbitrary date. There is a chance to kind of fudge things for a while longer. But maybe if we don't get through the next kind of week, it'll be that volatility which gets it over the line.
Okay, and so that's certainly a big focus for markets right now, isn't it? And you pointed out earlier on the strength we're seeing in Japan, and that's been the theme of recent days. And in fact, recent weeks, we've heard from Goldman Sachs and from Warren Buffett and from many of our guests about their positivity around the Japanese story. Today, there seems to be some more optimism around chips and that particular part of the tech sector. Do you share the enthusiasm around Japanese stocks?
I do. I mean, I will say it's had a really, really good run. So if you haven't been on the story now, it's maybe the wrong time to suddenly get super enthusiastic. But look, this is a stock market that's been very cheap. It's in a bit of a sweet spot in the economic cycle in terms of that the demand side inflation is dropped. We've seen commodities come down, the supply side, and yet we're actually basically seeing that the Bank of Japan is still providing easy conditions. They're very low yield, and therefore they're getting okay growth, not particularly strong. They're not having the inflation struggle the rest of the world is having, at least to quite the same extent. And you suddenly got this backing from Warren Buffett of a country that's really been considered the doldrums of investments for the last 30 years. Ever since it blew up 30 years ago, or more, a little over 30 years ago, people haven't wanted to go near it. So it's been gaining momentum for the last year. And I think it's no longer a cheap market, but it has a better story than other places. What I will say in the very short term is it's come a long way recently, and of course, the next month or two, we might get a DOJ policy change, and that might give it a bit of a shock in the very short term.
Yes, certainly, we pay attention to that. On the United States and your expectations of when we go into recession in the US, you're pushing out your time horizon there just a little bit. What's the explanation, briefly?
Yeah, I started this very briefly on the show, at the end of the show on Tuesday, or Monday or Tuesday. Yeah, I think it's September, October is my latest timeline. I was thinking June, July, that's what I said since last year. It's getting closer to June, I've got to change it. September, October, and that's the earliest I think it'll happen. I think the economy will stay much more resilient until then, and then it'll be more sustained when the recession comes, starting in that fourth quarter.
Okay, Mark, thank you very much for thoughts so far. Remember, you can get up-to-date analysis from Mark and all of the other members of the Markets Live team. MLID Go is the function to use on your Bloomberg terminal. Let us get a first word news update. Top stories we're covering here at Bloomberg. It's Sarah Paul in Dubai. Good morning, Sarah.
Good morning, Anna. President Biden has expressed confidence that negotiators will reach an agreement to avoid a U.S. default. Biden and congressional leaders have agreed to a narrow round of staff-level talks with hopes of reaching a deal. The U.S. president has shortened his trip to the G7 in Japan to continue negotiations in Washington next week. Deutsche Bank has agreed to pay $75 million to settle a lawsuit from victims of Jeffrey Epstein's sexual abuse. The suit accuses the German bank of facilitating Epstein's sex trafficking operation. JP Morgan is still fighting the suit filed against it, one of three involving lenders to Epstein. Deutsche Bank hasn't admitted to any wrongdoing and says it has bolstered its controls. A panel tasked with overseeing the credit default swaps market says a write-down of Credit Suisse's breached AT1 notes will not trigger an insurance payout. The regulator, which reached a faster-than-expected decision, should review that the additional Tier 1 securities were junior to the subordinated bonds underlying the swaps. AT1 investors were wiped out during the Credit Suisse collapse. U.S. commercial real estate prices dropped in the first quarter, the first fall in more than a decade. The data from Moody's Analytics showed the less than 1% decline was led by office and apartment buildings. Excluding farms and residential properties, banks accounted for more than 60% of the $3.6 trillion in commercial real estate loans outstanding at the end of last year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Hall, and this is Bloomberg. Anna.
Sarah, thank you very much. Sarah Hall joining us from Dubai. Coming up, as G7 leaders meet in Japan, one sizable economy that won't be there is
First pidam on
oil.
oil.
To attend or attending this time. More on what that could mean for the country's economic woes next. This is Big.
Second pidam on oil as well.
Welcome back to Bloomberg Markets Europe. 40 or so minutes until the start of cash equity trading for this Thursday morning here in Europe. And the European futures picture looks pretty positive, up by 0.5% on Euro Stoxx 50 futures right now. Looking to catch up with that optimism we saw about the debt ceiling negotiations in the United States. That certainly lifted Wall Street and US markets closed at a high. So no surprise that US futures look a little more negative, but not much. Now, let's move on to things geopolitical. As G7 leaders meet in Tokyo, one sizable economy that hasn't been invited this time around is South Africa. This year, Japan is inviting the African Union in its place. South Africa has recently been in a spat with the United States over claims it supplied weapons to Russia in its war against Ukraine. Allegations Pretoria strongly denies. Our correspondent Jennifer Sabasaja joins us now from location in Johannesburg. Jennifer, very good to have you with us. So what are you monitoring then when it comes to relations between Pretoria and G7 members? Clearly, these developments around the United States and Russia have been really central.
Right, and I mean, and this is really significant. I mean, the U.S. is South Africa's second biggest trading partner, and so a lot of eyes are on how exactly this will transpire. What you just mentioned there, I mean, we passed the peak of really the height of tension that we saw last week after that U.S. ambassador made those claims, but there's still a lot of questions about where exactly those claims actually came from. What we saw on Wednesday was that the ambassador was meeting with the ruling party here in South Africa, the ANC, to discuss some of the claims that he had. But we're still waiting to hear from South Africa's president, Ramaphosa, about what exactly it is that he wants to investigate, who he's going to appoint to take a look at some of these allegations that were made. And there's a lot riding on this relationship in particular. And as you mentioned, there was a lot of concern last week, which we saw reflected in the markets, about potential U.S. sanctions if this were to be true. And of course, we did not see that at this point in time. But there's not just that. As I mentioned, the U.S. is South Africa's second biggest trading partner. There's also negotiations next year for a major trade pact
AGOA is what it's known as, that is going to be renegotiated. And so a lot of the business community here is concerned that if the South African government does not take more of a definitive stance against the Russia-Ukraine war, then we could potentially see it affecting the economy here. For his part, President Ramaphosa has continued to assert that the country has a non-aligned position, but there's a lot riding on this relationship potentially, and other relationships that this country has with Russia and with other countries around the world.
Jen, good morning. You've made clear that South Africa needs to be more clear in its position versus Russia. But specifically, the weapons round, the allegations around that, is that now behind us, or is that specific issue going to continue to weigh on the economy in the West?
It's definitely still weighing on the economy. As I mentioned, Mark, we're seeing the rand come back slightly from the lows that we saw last week, but still a lot of questions about where these allegations even come from. We heard from the opposition party here in South Africa that they themselves believe that there is some validity to what the ambassador was saying. But just looking forward, South Africa does really need to definitively state where it stands on this particular war, and especially ahead of the BRICS summit, which is coming up in August here, where Vladimir Putin is supposed to be attending. And just the latest news that we heard from South Africa, in particular yesterday, is that they're planning a peace mission to both Ukraine and Russia to try to facilitate a ceasefire in this war. So we're really seeing the country really attempt to weigh both sides, but we don't know how long that's going to be able to last with the West, and how long they're going to be okay with it at this point. Okay, Jennifer, thank you very much. Jennifer Stabasad joining us there with the latest on the South African economy, geopolitical challenges that confronted. Coming up on the program, we'll get back to earnings stories. John Steinberg joins us, Chief Executive at the international multimedia company Future PLC. He joins us for an exclusive conversation. We'll talk about the numbers, see if the company is guiding a little lower for the market's expectations. We'll talk about that. We'll also talk about AI. This is Bloomberg.
Okay, Golda has resistant. Previously close and box.
Welcome back to Bloomberg Markets Europe. Half an hour to go until the start of cash equities trading. Here are our top stories. Deal insights. President Biden expresses confidence that debt agreement will be reached. House Speaker Kevin McCarthy says it's doable by this week. Client sentiment. Asian stocks extend yesterday's rally on Wall Street as conviction builds the USD can be effective. Last, we speak to the CEO of the media company Future PLC. Yes, it guides the market a little lower this morning. We'll ask John Steinbeck about the challenges facing digital media companies in an uncertain economic environment. Let us have a look at the future board then for you. And this is the
Okay,
European
please
picture
stay
right now.
close down.
Positive, catching up with the sentiment of yesterday when it comes to stocks over on Wall Street. We saw a lot of positivity coming through as a result of those conversations around the debt ceiling and the comments by the president and senior Republicans in the mix there as well. US futures a little less positive, it's still pretty flat actually this morning. Let's get to some of those earnings stories we've been covering this morning and innovation in Future PLC, the company which owns publications like Marie Claire, Tech, Radar. It beat revenue estimates in the first half, but the global media firm sees full year performance towards the bottom end of market views. So let's get into a conversation about what is driving things, an exclusive conversation in fact with the CEO of Future, John Steinbeck, who's here with me today in London. John, if I could just, good morning, thank you for joining us.
My first interview since joining the company 6 weeks
Absolutely,
ago.
only 6 weeks, so
Yeah.
congratulations,
Thank you.
well done for stepping into the studio so quickly, so we thank you for that. Let me ask you about your guidance
Yeah.
today. You seem to be guiding a little bit lower. What is it that you see there?
Well, it's definitely a challenging macroeconomic environment right now, and we're particularly seeing in the technology category a lot of pullback in spending and pullback in interest to consumers. We're heavily concentrated in the technology category. With that said, the half-year revenue was flat, 32% AOP margins, and free cash flow is converted at 100%. So I really like the hand that we have been dealt. I think
Can
others
we
will kill for the assets. I think we will navigate the turbulent times.
just at least go to
Okay, Mark, jump in.
John, good morning.
the
Thank you
green
very much for joining us
extension?
6 weeks ago, and you joined because of your very strong pedigree in digital media. But I guess on that point, are you a little bit worried that the digital media kind of model maybe has some fundamental problems? We've seen Vice file for bankruptcy, we've seen BuzzFeed close its news department, we've seen other rivals kind of cut jobs. How worried are you about the path for digital media as a concept?
Mark, I think there are different kinds of digital media companies, and I think Future really stands apart, and that's why I joined the company. We have what I like to call high-intent media. People go to Future to follow their passions, explore a specific topic, or research a particular product that they want to buy. So that's very different than media that's just kind of thrown out there digitally that people either consume or don't consume. We have this high-intent media. That's why our yields were actually up in the half year. People were paying more for our advertising. People were paying higher affiliate rates. All of those things kind of play through in the half year, which makes me even more convinced of the opportunity ahead.
Okay, and just on the things that drove the guidance correction today, you talk about being overexposed, or there's a lot of exposure around tech. So what is it that you're seeing there? Is this tech advertisers pulling back on their commitments? Where's the area of weakness?
Yeah, so there's that. There's an FX headwind we're going to be facing. We're also going to be investing more in the U.S. And then there is an overall macro pullback in advertising right now. That softness that Mark was pointing to a moment ago.
Okay, John, you talk about macro softness. You present a very compelling case for why Future has got a bit of a competitive edge in this digital media space. What does that mean for Future in terms of job cuts? Will there be job cuts in 2023 from Future?
No, there's no plans for job cuts right now. In fact, we're actually putting in more resources into the U.S. to seize the sales opportunity there. That's my background. The U.S. ad market is 7 times larger than the U.K. market. We have forecasts to grow our U.S. revenue substantially in the coming years, and we in fact want to invest more. And in fact, recently I just put in place an editorial, what I call surge, where we're producing more articles now than ever before. So we are very much in an investment mode right now, and no layoffs are planned.
Okay, and your interest in the US is interesting. That's a growth market for you. You've got a lot of US experience, as we said, to bring to this, so driving growth there. A number of businesses are thinking about US capital markets at this point,
yes.
And a number of London-listed companies are wondering about whether they should list elsewhere, over in the US or in the US also. Is this part of the conversation at Future PLC?
No, it's not part of the conversation, and I'll tell you why. We have so much coverage, analyst coverage here that's exceptional. We have media coverage here. We're a FTSE 250 company. I don't believe we would get the level of attention from the markets in the US that we get in the UK. So I think we're very happy right now with where we are.
John, you kind of present this idea that you're going to seize the opportunity of the macro slowdown. You've got a competitive edge versus rivals. You're going to use that to kind of essentially grow and expand. Are you going to continue with acquisitions? If you can context that over 4 years growth, business more than 250 brands. So is there much more M&A on the cards?
Absolutely. M&A is an integral part of it. M&A is really because we acquire inorganic revenue and earnings, and then we have what we call the platform effect. When we move into a customized solution technology called AI, we're actually able to recognize cost savings, revenue uplift, and the like. So it's a very fundamental part of it. One other thing I would point out, Mark, is people think future acquires at 10 times or even higher than that. Our most recent 2 acquisitions we acquired at 7 times, or below 7 times in fact. So we're actually seeing the sellers become more rational in the market, and we have as active a pipeline as ever, and it remains an integral part of the story, and we have not slowed down since I've joined.
Right, and can I ask you about, you mentioned how you get good coverage from analysts here in the market, and that's an attraction. I noticed that at the beginning of March, you actually got your first sell rating. There hasn't been one. It might have been before you even joined the business, perhaps, yeah. But that now exists. I mean, the quote from the analyst there is that all the good things must come to an end. The stock price has been challenged for a good few months. How would you respond to that?
I would respond to that by saying the advertising market is cyclical, and that innovation solves all problems. And then ultimately, this morning we launched an AI chatbot on our website, Tom's Hardware, that allows people to go in and ask questions about should they build or buy a PC, what components should they do, and then it spits out relevant articles as well too. I think whenever there is flux or change in the media ecosystem, it offers up opportunity. And I think now is a great time for me to be joining the business during tough trading conditions, because basically I can build from here and innovate and kind of take us to the next level.
So you've answered my question. AI is an opportunity. You're using it. You're availing of it. But you talked about the fact that advertising is cyclical. What are the trends specifically in digital advertising market right now?
I mean, the trends that we're seeing are that advertisers are hesitant and making very last-minute decisions about doing their buys and their insertion orders. So the market is probably the most fluid that I've seen it in my career. With that said, we are closing deals, we are signing insertion orders, we are seeing our yields at an all-time high. So the yields are actually what really matters here, which is advertisers are paying a premium for the advertising inventory that they can get right now. So when we are doing the deals, they are coming after our specialist media and our specialist high-intent content.
And you mentioned the AI push. I just want to ask about that. You said from Tom's Guide, an AI chatbot, but if people are using it to find information about the latest technology, is it providing a step change from what just Googling or using some other search tool will provide? I mean, what does that kind of AI chatbot really bring?
I think it brings a sense of experimentation, and it provides our users with a new way of beginning what's a complicated journey. Tom's Hardware is a very specialist site that people go to change out their graphics card or change their chip or something like that. The experience is pretty great when you ask it, how do I change out a chip? It gives you a text answer and then articles where you can delve deeper. That's why I'm really excited about AI. I think it'll be, people will do chat, and then they will still need to do more research through articles and reading. I don't think you get that paragraph and you're like, I'm done. Like, it's not really enough of an end journey. So I think that there's going to be a whole progression, and we'll do more of that. We're also actually experimenting in Australia right now, doing product specifications generated by AI, which saves labor. We think it cuts down on about a third of the labor of producing a piece of content.
Okay, John, thank you so much. Thanks for joining us. Good to speak to you. John Sandow, the CEO of Future. Thanks for being with us this morning. Mark, let's come to you then with your thoughts on the market. And I know that, the debt ceiling is a conversation that's dominating thinking right now. But you've been thinking about something fundamental. You've been thinking about valuations on the big global markets around the world. What did you conclude?
Yes, I think the backdrop picture that I've had for the last couple of years, I kind of get kind of church and started last year, was that US stocks were underperforming the rest of the world. Whether you're bullish or bearish, that's the kind of central idea. That did happen last year. I was probably about 6 months earlier on the idea. And I think that's the theme for the next decade overall. But actually, I'm presented today to kind of look at valuations, to kind of say, temporarily, just in the next couple of weeks, I think we might blow up that theme just a little bit, because everyone's starting to buy into the idea that US stocks are going to underperform everyone. Bearish stocks, but everyone's getting bullish again. And I think that if we get a debt ceiling resolution, which I am expecting, it'll suddenly be yay and cheering all things America, and we'll squeeze out those trades for a little bit. But with that said, let us have a look at the long-term valuation. So this is the S&P 500. and its best estimated PE ratio on a 12-month forward, then a 12-month forward. And this is where it is now, just above the long-term average. That's that red dotted line is the average. So US stocks are no longer super expensive like they were back here, and I was getting very upset about them. But they're not cheap. I'll tell you, it's very important to remember. They have a premium, despite the fact people all about the Fed tightening rates and we're heading into a recession. US stocks still have a premium to the 10-year average. Now, very quickly, I want to show why everyone is more bullish than the rest of the world. Looking at Euro stocks, still cheap. Now, you might say it's a much more negative picture, but it's just to point out that they are much cheaper than their 10-year average. So maybe the discount is kind of fair. And then going to Asia, China's got fairly valued now, not outside of Japan, fairly valued. But Hong Kong, one of my favorites, again, I'm trying to point a little bit early on, is still extremely cheap relative to its long-term average. So I think that kind of buys into the theory that, yes, it is valid to be bullish the rest of the world versus the US over a long-term horizon. Over the next couple of weeks, that trade is becoming consensus and might be a little bit vulnerable to a debt ceiling resolution.
Okay, really interesting thought there on relative valuations of these markets around the world. Thanks to Mark Local. Let's get a Bloomberg Business Flash. Top corporate stories that we're covering this morning here on Bloomberg. Here's Sarah Hall in Dubai.
Hi, Anna. Bloomberg has learned that Meta Platforms is to be handed a record privacy fine by the EU, eclipsing the net €750 million penalty proposed on Amazon. Ireland's Data Protection Commission, which oversees the EU operations of most Silicon Valley firms, will punish the owner of Facebook and Instagram for failing to protect users' data from the prying eyes of US security services. Cisco shares fell in US extended trading after network game makers said orders declined 23% in the past quarter. Its CEO said a difficult economic environment contributed to some caution, but the company still raised its full-year sales forecast as it expects an improved supply chain to boost demand. Micron is poised to land about $1.5 billion in financial incentives from the Japanese government to help it make next-generation memory chips in the country. Sources tell Bloomberg the US company will make RAM chips as its facility in Hiroshima uses advanced technology from ASML. The deal is the latest step in Tokyo's effort to boost its semiconductor production. Prior to this pandemic reopening has seen Tencent post its fastest pace of revenue growth in more than a year. Sales rose 11% in the first quarter, but net income fell short of projections, reflecting an uneven recovery for China's internet sector. Tencent's plans to integrate artificial intelligence are now likely to be a focus for investors. And that's your Bloomberg Business Flash. Anna.
Sarah, thanks very much. Sarah Hall in Dubai. Coming up on the programme, President Biden jets off for Japan. Their teaming talks remain stuck on the tarmac. We will have the latest on those negotiations next. This is
Okay. Okay, so pretty much everything looks like I will bring my own. Not the nicest. But we go with the same thing actually. I like this thing. It's very, yeah, it's really nice, like gentle white for the eye.
Okay. Alright, well, I'm just getting ready here.
Okay.
Biden is striking an upbeat tone despite receiving criticism from Republicans for traveling to Japan to attend the G7 summit.
I'm confident that we'll get the agreement on the budget, that America will not default. And every leader in the room understands the consequences of failing to pay our bills. And it would be catastrophic for the American economy.
Let's get more from Bloomberg senior editor Bill Farage, who joins us in Singapore. Clearly, this is something that's going to follow him at the G7, isn't it, Bill? The latest on the debt ceiling. He's going to be physically in Japan, but I wonder if he's sort of still going to be very much present in Washington in a sense.
Absolutely. I think he'll have to be checking in with the negotiators back in Washington pretty regularly. He already canceled the second half of his trip to Papua New Guinea and Australia just so he could get back in time to help shepherd these negotiations. And I think they're going to be on the minds of a lot of the other world leaders gathered at the G7 who see this as a reckoning point for the U.S. and whether it can get its house in order, pass a higher debt ceiling, and keep paying its bills.
So, Bill, how optimistic should we be that debt ceiling resolution is going to come? With not much information, I'm pretty optimistic because I see that all the leaders are saying we're going to avoid default. I'm not seeing the hard line that Bill might take to be on. Everyone might be arguing, where they're going to concede, but everyone seems to agree we need to reach a resolution. So should we be optimistic or not?
I think we should be cautiously optimistic.
Ale there was
both
drama.
sides saying that they want to reach a deal, that they think a deal is possible. That's good news.
Yeah, but there wasn't any like it
Considering
proper
markets,
that
looking
he
towards
from
June
the
1st, which could
way
be,
which I was
could be
approaching
the
it.
end date that we know about. The caution comes from the fact that if June 1st is the date, the House and the Senate, that's the reality of capital bills, they have to have legislation moving, say, 3, 4, 5 days before that date just to get it passed. So to raise the debt ceiling on June 1st, if you think that's the deadline, you need to have legislation moving by the 25th, 26th of May in the two houses of Congress for that to happen.
Okay, that's really good information. Towards the Wednesday or Thursday next week, I've got to ask that question. I will say that all I cared about was the debt ceiling until this morning, and now it's not the biggest story out of the US. But this morning I saw stories saying pickleball. I'm sorry, it's a bit of a swivel. I don't know debt ceiling, but you're American, you're over here. Explain to me.
Okay, 1 minute changing red on road view up, it's still green.
A fake sport, and now I'm getting told it's a massive investment opportunity and bigger than the NBA. Explain.
markets. Europe, 9 minutes until the start of an equity session that looks as if it could be positive, picking up from Wall Street yesterday. US futures points a little lower. Let's get the individual stocks we're watching. Some really fascinating stories breaking this morning in London, but elsewhere too. Joe Easton joins us from our equities team, and he can take us through some of the highlights. In fact, it is an entirely UK lineup, isn't it? Let's start with Burberry.
Morning, Anna. So Burberry today reporting some pretty strong numbers. They are saying their retail sales in the full year were up around 2% to £2.5 billion, and their dividend is about 5 pence better than what investors were looking for as well, at 61 pence a share. However, expectations were really high going into this report, as we can see by the stock on the screen here. That hit a record high just a few weeks ago, up 25% over the past year. Their new lines of clothing from their designer have been well received, but don't actually hit the shelves until later this year. And it's one of the most exposed companies to China in terms of the luxury space as well. So as I say, investors hoping for a lot, but these numbers do look pretty strong out of Burberry this morning.
Joe, good morning. We also had results out from BT, and I know the really exciting story beyond the earnings headlines was the fact of immense job cuts in the horizon. Tell us more about that.
Exactly, Mark. So big numbers in terms of those job cuts. They could cut around 42% of their workforce. So that includes both employees and contractors as well. They do employ around 130,000 people in the UK, so it's a massive workforce. If we look at the numbers, we can kind of see why. They are reporting adjusted revenue down 1.5% for the fourth quarter, and full year pre-tax profit missing expectations by some mark as well. Now, the company has recently announced plans to cut around $3 billion in costs, so we already knew they were looking to do some of this. And it also follows Vodafone earlier this week announcing some big job cuts as well. Part of the reason this stock has struggled is due to competition in broadband. We're seeing price rises at all of the companies, but BT is actually rising by probably the most among peers like Sky and Virgin Media. So a lot of competition heating up. That's really hit that stock. And these job cuts probably a result of that, I think.
Yeah, the role that this market, more broadly, not just broadband, but also telecoms in general, plays in inflation, an interesting one. Let me ask you about Aston Martin then, Joe, because we've had some news out around an investment.
That's right. So this was really exciting news from the auto space today. Geely, China's big auto maker, committing another £234 million investment in Aston Martin. This is at 335 pence a share is what they're going to pay to increase their stake. They're already one of the largest holders, but will move up to be the third biggest holder in the company. And we can see that's a decent premium of around 100 pence in terms of what they're paying. But as we can see, this is a longer term chart showing a few years. We can see that stock really languishing down at the lows. Has come back a bit recently, given they've invested a bit in Formula One. There was a bit of excitement around Fernando Alonso, the Spanish driver, boosting that brand there. But there's been big worries that they would need to do a capital call, and this could potentially ease some of those concerns. Definitely a positive one with some Chinese investment in Aston Martin today.
Joe, thanks very much. Our equities reporter Joe Easton with the latest on some of those stocks in focus here in London. Mark, let's go stateside in the last minute or so of the programme to think about the real estate sector there. We had some data out from Moody's, which showed that for the first time in a decade, we've seen a drop in US commercial real estate prices. That's something that many people have been watching and fearing to a large degree. But having said that, the drop isn't very big, is it?
Can we start affecting the bearish reverse trailing stop of a sale after we failed to the high?
But I just think in context that we've been negative about commercial real estate for about a year, and that the decline is less than 1%. And I think this goes back into the issue that people are struggling with the lags for some of these stories. Commercial real estate is a real problem. It's a real problem for regional banks out there. But it's only just starting to be a problem. And when is it going to be an intense problem? Probably the back end of this year, Q4, not quite yet.
Okay. And that's the important link to watch for, isn't it? The way that this ties into the banking sector. Thanks to Mark for spending the past hour with us. The Open is up next. Futures have been pointing higher, picking up on Wall Street. US futures.
4 minutes to open. We'll see if we got the new low. one crot, you can go higher. And then Q. "30 seconds, we'll know what's happening."
Welcome to the European market open, everyone. A minute to go until the start of cash equity trading across the market. I'm not going to be
And here in top stories, President Biden expresses confidence that a debt agreement will be reached. House Speaker Kevin McCarthy says it is doable.
Ooh la la, London.
European futures and Asian stocks rise. G7 leaders gather in Japan for a summit where China and Russia's war in Ukraine will top the agenda. We are live in Hiroshima. Plus, EasyJet says it's benefiting from higher ticket prices heading into the peak summer season. Meanwhile, Burberry's earnings beat estimates as shoppers in China spend again.
Tom, let's look at the futures for the moment. DAX futures gaining 0.5%, and if you look at FTSE, they're also getting by similar gains. I mean, there's really hope actually in Washington. There's a narrow group of negotiators that will break through and get a deal on the deficit.
Yeah, the number has been shrunk to about 5 individuals on both sides working through this issue. The dial arguably been moved in the right direction then. They still haven't got the deal, of course, but there is a little bit of positive mood music emanating from DC, and that lifted certainly the stocks yesterday in the US. You had a decent value, plus 1% for the S&P, and the Nasdaq also ending the session in the green. So a handoff is positive from the US. The stock story, the equity story at the moment really is all about Japan, and we'll zero in on that shortly. But currently the FTSE 100 adding to the optimism with gains of 0.4%. We continue to work through the earnings picture as well. BT with some job slashing going on there. Bad news, of course, for the workers of BT. Arguably good news for investors in that stock. FTSE 100 currently up 32 points. Spanish IBEX 84%, and overall France, the background up 0.6%. Of course, that says then, let's switch the board and just briefly touch in on what has happened in terms of Japan. Further gains there at a 33-year high. The Nikkei up 1.6% in the session. Again, this week, exports are stronger, adding to the optimism. And 7 straight weeks now of foreign inflows into Japanese equities. Futures in the US pointing flat, range bound, maybe a little bit of profit taking coming through after the gains of yesterday. The 2-year at 416, 7 basis point move higher yesterday at the front end in terms of yield. Currently 416, so comfortably above that 4% level. Gold back below 2,000 as the risks around the debt ceiling seems to come off at least a little bit. 1,976 on gold, just down 0.3%.
Tom, let's dig a little deeper into the sectors. I should have worn my green sheets and my red sheets because I'm seeing quite a lot of green out there on the market. So 20 groups that make up the stock 600. We go in Europe, and actually there's only one on the way down. That's utilities, and it's in the red, but pretty much flat. Now the gains are not huge. I'm seeing auto parts, the biggest gainer, technology,
Unkligen
gaining some 0.7%,
price
8%,
nicely.
but in a little bit of optimism. So we did have Burberry sales again better than expected, but in general, just a bit of optimism that we get through the US debt ceiling.
Okay, talking the debt ceiling, President Biden has expressed confidence that negotiators, as we mentioned, will reach an agreement to avoid what, of course, has been described as a potential catastrophic default. We heard from the US President yesterday.
I'm confident that we'll get the agreement on the
Why
America.
it's really
And every leader in the world
going
understands
nice
the
and
consequences
high.
if we fail to pay our bills. And it would be catastrophic.
70 years, much stronger moves. They make already the highs of the Frankfurt.
Now in Singapore, who follows this for us very closely indeed. Derek, what more is needed then to get an agreement? McCarthy saying that it could be done by the end of this week.
Yeah, well, I think by the end of this week is a little bit optimistic potentially because Joe Biden's on a plane to Japan right now. They have said that the president will be able to talk with members of Congress. The president is deputized, some quite serious bipartisan negotiators to be able to fill in the terms. They sort of know where the framework of this deal might actually materialize. I mean, if I were looking at it, I would sit there and suggest to you that some future limitations on spending, some maybe budget caps would be one area. Rescinding some unspent funds, particularly COVID funds, would be another one. I think there's a possibility of something on the line of regulatory reform in terms of permitting, and maybe some other things. The big hitch right now is over work requirements and other such restrictions on entitlement programs and the U.S. Safety net. And I think that is the real key. There's a lot of things that are Democratic red lines there. Democrats don't want any work requirements on some of these, and if you got them, even though they're big Republican priorities, it actually might make it difficult for Democrats to be able to sign on to the final passage, which would be its own problem of complication. Essentially, even though there's a possibility of a deal in sight, right? You have to be careful that you don't win by too much, because if you win by too much, it's going to be hard for the other guys to vote for what you signed up for.
Yeah, so Jared, so this is kind of like, what if we're a little bit of a false sense of security that everyone's cautiously optimistic? If you listen to what Mr. McCarthy was saying, I mean, Mr. President, stop hiding, stop traveling. Is this just rhetoric, or, is there optimism, and then in a few days could we see nothing and fall flat on our feet, from our faces?
Well, I think, I mean, look, I think we can fall on our feet, we can fall on our face, we can fall on a whole bunch of other places, and a lot of it's in play, right? A lot of it's in play, but like, one of the questions I've been asked time and again is what's going to be taken. Or I've said a long time, you got to get to more pain before you get to progress, and we've actually seen with the White House
Trailings unbroken.
cut short its Pacific trip that
My short.
scrapping a trip to Papua New Guinea, scrapping a trip to Australia and the Quad, inviting questions about the U.S. seriousness in the Pacific. That counts as actual honest to goodness pain and suffering that will I guess crystallize the need to get something done here. So that's very, very possible. I also, as I say, I would not overlook the idea that even if a deal is signed, it still has to get passed. Now, I'm optimistic that something will get done at some point. There are plenty of off ramps here to diffuse a crisis, but you have to be willing to take them, and you have to figure out a way to do this in a way that's going to allow everybody to come around and support it when the vote actually happens in Congress.
All right, thanks so much, Jared. Well, back in Singapore, President Herbert, he's also just arrived, of course, at his next destination in Japan. People looking at live pictures. He did yesterday express confidence that negotiators would reach an agreement, but actually this is not, a G7 that's plain sailing, because of course some of the Republicans have said, well, the president, in the midst of these very, very important negotiations, should not be in Japan at G7. That's touchdown actually in Hiroshima as Air Force One just landed. I think we're going to probably see the president come out of the plane soon. It's rather exciting always.
Yeah, and as you say, cutting short the trip then.
Can see the POC drop down.
He doesn't think there's going to be a deal until he's back on the ground in DC. So missing out on a planned trip to Australia, and as Derek was saying, Papua New Guinea as well, really important in terms of the geopolitics, particularly China's reach out to PNG in the last few years. So we were waiting for the president to step down off the steps, of course, of Air Force One in Hiroshima ahead of this G7 leaders meeting. We know, of course, China will be central to the discussions there, as will Russia and Ukraine. Also, on the UK front, interesting that Prime Minister Rishi Sunak is set to announce a deal with Japan around semiconductors and chips. But this is the US president waiting for Joe Biden, of course, Air Force One, who wait for those red steps to be put down the side of that aircraft and to be welcomed, of course, by his counterparts in Japan. We will get more analysis, of course,
Now, joining us to talk about the markets and to talk about the debt ceiling, Sharon Bell, Goldman Sachs International Senior Equities Franchise and Co-Head of the EMEA Global Investment Research. Sharon, thank you for joining us. Given there's cautious optimism that actually both parties will reach a deal in the U.S., where do you park that wall of worry?
Sorry, what was the question there? Where do we park?
The wall of worry. What do you do with the debt ceiling? Do you have to, plan for it, or do you ignore it for the moment?
It's so tricky, isn't it? Because markets have largely, I would say, been ignoring it. More the equity market ignoring it than the bond market. The equity market obviously fell very, very hard in 2011 when they didn't raise debt ceiling initially, and there was an impact of growth, and there was a lot of confidence as well. I think at the moment the equity market is priced for the hopeful outcome that they do pass the debt ceiling increase. And I think that within the equity market, they do see people steering a little bit more towards quality companies, defensive companies, maybe growth companies as well, rather than value companies, and cyclical companies that I guess would be most hit.
Would you follow that positioning, Shannon?
Yeah, generally I would in the near term. I think that it is a fragile situation, but it's not just the debt ceiling which is the issue here. Growth itself is quite weak at the moment, likely to be weak in the second quarter and the third quarter. Equity markets look relatively expensive, particularly versus other assets like or you can get on money market funds at the moment, 4 or 5%. So to us, equities look quite fragile on a number of dimensions, including this one concerning the debt ceiling. So I will be slightly more steered towards quality, yes.
So, Sharon, is this equities in the US that you're more concerned about, or is it worldwide because implications could be big on the debt ceiling?
I think we worry more about equities in the US. Again, the debt ceiling is still part of that, but I think it's not the main issue for us on US equities. The main one is valuation. We don't have a lot of earnings growth this year. It's likely to be close to zero earnings growth. And yet the equity market in the US trades on 18 to 19 times PE, which is the top of its 20-year range, toward the top. So you have got an expensive market, you have a lot of risks, including the debt ceiling one, you have relatively low economic growth at the moment, and that means we just don't see a lot of value there in US equities. We think returns will be low, and in fact our equity target at the end of this year is 4,000, already above that level. Elsewhere in the world, of course, the US equity market dictates global markets to some extent, but you can make the return elsewhere. Your program was mentioning Japan, that's been a strong market. We generally like non-US equity markets, and Japan in particular, we've got an improvement in return on equity coming through, that's helping earnings, and that's a big fundamental case for buying Japan.
With more evidence in terms of weaker data, more compelling evidence that maybe the Fed is weighing up a cut by the end of this year, would that draw you back to US markets? JP Morgan's private bank telling us yesterday they actually expect 2 cuts to come through from the Fed by the end of this year, saying the markets are right in terms of broadly the pricing on that. Do you push back on that?
We would push back on that, yes. For us, we don't expect a recession in the US. We just think growth is going to be pretty weak in the next couple of quarters and close to zero. But we are not looking for a deep recession. We are not looking for GDP to fall over the next couple of quarters. And we think the market is a bit premature in expecting rate cuts this year. We do expect rate cuts eventually. We do think the Fed has peaked in terms of interest rates, but it will pause and plateau from here for the rest of this year and not cut until we get into 2024. And the reason for that is we don't have a steep downturn, we don't have a recession, and we still think the labour market is very tight.
Sharon, we're looking at live pictures of Air Force One. We're expecting President Joe Biden to actually step on Air Force One. This is a very familiar scene to those who cover the president and cover, of course, the White House.
That was my entry long after seeing the bearish reversal line and having the green line on the string oscillator. I should close the short entry long.
Look at loopholes of sanctions on Russia, a message to China. They'll talk about nuclear weapons and then AI. Sharon, how difficult is it to have a constructive bet on some of the Asian equities, given, I guess, the cold shower that we're seeing between not only US and China, but it's unclear what Europe plays in this. They're trying to get more aligned with the US, but also need those economic ties with China.
Yes, and in Germany in particular. So Germany in this last year had 2 big threats, really. Higher energy prices because of the sanctions against Russia, but also the fact that its big export market, China, originally was locked down for a lot of that period, but also there is a lot of geopolitical tensions at the moment, concerns about China, relations there are very frayed, particularly with the US, and that's potentially restricting Germany's growth and exports to China too. So I do think Europe is very much caught in this. Europe is one of the markets we find is most sensitive to global trade, because it sits in the way of a huge global trade patterns, is very vulnerable to that, no doubt.
Okay, the sensitivity of Europe to a global trade, and we'll get some lines, no doubt, from these G7 leaders on global trade over the next few days. Sharon Feltz will stay with us over the next couple of minutes. We'll get more Sharon's calls just in the next minutes off the break. Goldman Sachs, of course, International Senior Equity Strategy Co-Head of EMEA Global Investment Research, staying with us. Still seeing those live pictures, of course, Air Force One has touched down in Hiroshima ahead of that G7 leaders meeting. President Biden, of course, expected in that doorway and to walk down the steps any minute. We'll get across that, of course, and keep across that story for you. Across these movers, then, let's touch in one of the big stories of the day, certainly here in the UK. It is BT Group announcing massive job cuts, about 40% of its workforce. You can see the stock taking a hit there, down currently a little over 8%. The earnings as well coming through for BT. On the jobs front, they're going to be cutting staff levels from about 130,000 to between 75 to 90,000 by 2028 to 2030, saying that they're going to have a much smaller workforce. The CEO of this business has been targeting savings about £3 billion a year. Earnings, by the way, it was actually a beat in terms of the earnings estimates, coming in at just over £2 billion in the fourth quarter. But it is those incredible job cuts coming through for BT that are in focus really for investors. The stock currently down a little over 8%. Aston Martin, wow, soaring. Geely upping its stake. Geely is now the third largest shareholder in this luxury sports car maker based here in the UK. Of course, they can afford the fifth largest shareholder, the third. They now own 17% of that business. A big boost there coming through in terms of the money from China. Burberry down 5% on the earnings picture. They did some sales up 7%. China coming back, but investors not overly convinced at this point. Coming up, EasyJet says it's benefiting from higher fares as summer travel demand picks up. We're going to bring you more from our conversation with the CEO of that business. That is next. This is Food Break.
Whoa! The German market is flying. Same with the FTSE. They closed the gap from the open almost. Very few. Okay, picks up a neutral. London grabbed the liquidity from Tokyo high. Same ES. Okay. RTI on YM. They done only. They just about to go there.
It is a strong demand environment as well. And just
They testing previous they close.
customers partnering with us than last winter as well. And this is something that is come from two things really. One is that people have really looked upon travel now, differently than they did prior to the pandemic. This is now firmly at the top priority when people choose on how they're going to, allocate their discretionary spending, and that is something that is coming through in the numbers as well. So we are ahead of last year now in terms of booking from a load factor point of view, both in Q3 and Q4, and we're looking forward to that to continue.
Okay, so despite the loss, you're presenting a very positive picture about consumers willing to spend on travel. The outlook's looking positive. Return to growth later this year. Will you be placing a large order for a new aircraft, like some of your rivals have done, like Ryanair and Wizz Air?
Well, I should just remind you first of all that we already have an aircraft order of 163 aircraft. So that's the current order that we have that we will exercise, and that will take us out to 2028, and that is a combination of both replacement of the existing fleet that we have, but also then growth as well. But already, if you're looking at the growth numbers, we are growing our network, and excluding some of the changes we've done to some of the underperforming bases we have. In the UK, as an example, we have 1 more million seats this summer than we had last summer, as an example as well. So, we will continue to grow, and already for next year, we're looking at 10% growth, and we have the fleet in order to support that.
So, yeah, and you say you're increasing capacity. You have more aircraft coming in. We discussed about how some of your major rivals do as well. You believe in the UK. You've got an extra million seats flying to the UK. There's something you mentioned. Are you worried about excess capacity coming into the system? And what's that going to do for yields?
Well, it's an interesting question. I think because of the OEMs or both Airbus and Boeing have, documented, challenges in terms of delivering on their orders, we think we're in a good position on that. We're one of the largest customers of the Airbus A320 family, as an example. So we believe that, we're going to be able to mitigate any challenges that might be coming. But I think in general, you see that the supply from a manufacturer's point of view will be relatively tight here from the next 3-4 years. So of course, that would have a positive impact on the yield environment, as long as we see that the demand that has been strong continues to be strong.
Okay, that of course was EasyJet's CEO, Johan Lundgren, speaking to Bloomberg on the back of its results this morning. Let's stay on the UK then and bring Sharon Bell back in, Goldman Sachs International Senior Equity Strategist and co-head of EMEA Global Investment Research. Sharon, thank you for your patience and for sitting by there. On the UK, the FTSE 100, the FTSE 250, underperforming year to date. Is this a question of sterling strength or the mix that we're seeing in UK equities? And do you expect that to continue, or is there a turnaround story coming for UK stocks?
I think sterling strength perhaps hasn't helped here, but I think the main thing is the mix, what the UK is exposed to. It doesn't have tech companies, very, very few, particularly in the FTSE 100. It has a lot of energy stocks in the FTSE 100, and of course energy prices have fallen. It's been quite weak so far year to date. Mining companies as well have been hit by weaker industrial metal prices as well. So when I think about the commodity complex, which the FTSE 100 is very exposed to, we've seen weak prices there. And then on the FTSE 250, I would have actually expected the FTSE 250 to benefit a little bit from the strength of sterling. The strength of sterling is indicative of better economic data in the UK, better than was expected, and a higher sterling strength will benefit FTSE 250, but it hasn't that much.
Sharon, I know you can't talk specific stocks, but BT, the stock is ugly today. It's cutting 42% of its workforce by 2030 because of the rollout in fiber. Is there, do you like telecoms in general, because we're going to see more consolidation and possible M&A?
Yeah, we reasonably like telecoms. I think it fits in with a sort of characteristic where we're looking for more defensive areas, let's say, in a market where we're expecting very little returns over this next 6 months a year. BT also offers a reasonable dividend yield as well, and so does telecoms more broadly. So the dividend yield is the defensiveness of the sector, and you're absolutely right, we're seeing a little bit more consolidation in the industry, which would mean a bit more pricing power as well. So there's lots of things that make the telecoms industry a little bit more attractive. I think the concern for telecoms is one of the most indebted sectors in the market, and of course borrowing costs and yields have gone up as well. So there's that little bit to sort of weigh against some of the more positive things.
Sharon, thank you so much, as always, for giving us a little bit of the Goldman Sachs strategist and co-head of the EMEA Global Investment Research. Now, coming up later today, Guy Hans, chairman and founder of Terraform Capital Partners, joins us to discuss the future of the UK economy. Stay with us for that, and this is Bloomberg.
Slashing jobs. That's the plan, back to 40%. It's the disappointment around cash flow coming through, the guidance there that's weighing on that stock. Aston Martin rallying, Geely moving from fifth largest shareholder to third. Coming up, we're going to get more on the G7 Summit. This is Bloomberg.
Antonina, here is your reminder.
Alexa, stop.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. President Biden expresses confidence a debt agreement will be reached. House Speaker Kevin McCarthy says it's doable by this week. European futures and Asian stocks rise.